Decisions made by an unelected official in a Mumbai office dictate whether you can afford the interest on a car loan or how much your weekly groceries cost. That official is the governor of the Reserve Bank of India. Their authority rests on one specific rule. The RBI is the bank of all banks. They manage accounts for the government and commercial banks, but they never deal directly with the public. Money flows from the RBI to commercial institutions like SBI or HDFC, and from there it reaches you. If you attempt to open an account or take a loan directly from the RBI, they will turn you away at the door. This separation means the RBI must influence you indirectly. By pulling levers that change how commercial banks operate, they trigger a chain reaction that eventually reaches every bank account in the country. The first of these levers is the repo rate. When a commercial bank needs short-term cash, it borrows from the RBI by providing government securities as collateral. The interest rate the RBI charges for this transaction is the repurchase, or repo rate. If the RBI lowers the repo rate, borrowing becomes cheaper for the banks. To attract more customers, those banks then lower the interest rates they charge you for personal and business loans. As loan rates drop, people borrow more to buy homes or expand businesses. This surge in spending and investment increases production and drives national economic growth. Because of this connection, the repo rate acts as the primary accelerator or brake for the country's economic momentum. The repo rate is the center of a larger rate family. Below it is the reverse repo rate, which the RBI pays banks to park their excess cash. Above it sits the marginal standing facility, or MSF, a high-interest emergency window for banks that need cash overnight. At the very top is the bank rate for long-term lending. Regardless of the economic climate, this hierarchy remains fixed, moving from the lowest rate to the highest. Consider a scenario where national inflation hits a dangerously high 8%. To cool down rising prices, should the RBI increase or decrease the repo rate? The answer is an increase. By raising the repo rate, the RBI makes money more expensive to borrow, which slows down public spending and brings inflation back under control. While rates control the cost of money, the RBI also controls the literal supply. When you deposit 100 rupees into a bank, the law prevents that bank from lending out the full amount. The deposit is split into 3 parts. The first portion is the cash reserve ratio, or CRR. This is a specific percentage of the bank's deposits that must be kept as liquid cash with the RBI. This money stays locked away and earns the bank 0 interest. The second portion is the statutory liquidity ratio, or SLR. This also mandates that funds be set aside, but allows the bank to hold them in safe, interest-bearing assets like gold or government bonds. Only the cash remaining after satisfying these 2 reserve requirements is legally available for the bank to lend to the public. By raising these ratios, the RBI forces banks to lock away more cash, directly reducing the total amount of money circulating in the economy. In a high inflation crisis, the RBI uses these tools in tandem to remove excess money from the system. They raise the repo rate to make borrowing more expensive, while simultaneously increasing the CRR to physically lock up the bank's cash reserves. This 2-pronged approach makes money both harder to get and more expensive to own. This visual summary captures the entire toolkit. Screenshot this for your records: the hierarchy of interest rates on the left and the rules governing cash reserves on the right. Controlling the cost of borrowing and the volume of cash in circulation allows the RBI to regulate the purchasing power of every citizen. These mechanisms provide the framework